Hello class. Our discussion about inventory will focus primarily on Lifo and some other inventory complications. So these are the things that you didn't get to in Accounting 101. So first of all, Lifo, some things to remember. It is not allowed under IFRS or International Financial Reporting Standards. U.S. GAAP is the only place that it is currently allowed. It requires extra work and disclosure. One of the things that you must disclose is the Lifo reserve. Lifo reserve is the difference between your inventory calculated using Lifo and your inventory calculated using FIFO. So that means you essentially have to have your inventory done both ways, twice as much work, roughly. And to give you an idea of what the disclosure might look like, this is a footnote from ExxonMobil, and you can see that right here they talk about the aggregate replacement cost of inventory was estimated to exceed their Lifo. So replacement cost is another way of saying FIFO because it is the most recent things that are in your inventory, the ones you just replaced. And the old stuff is what you sold, or that's the assumption. Will exceed their Lifo carrying values by 8.1 billion and 4.5 billion on those two dates. So their Lifo reserve for 2016 was 8.1 billion and for 2015 was 4.5 billion. So the difference between those two, between the 2 years, would have gone to cost of goods sold. So you can see that that could be significant, since their income by itself was only about 10 billion. So that difference there, about 4 billion, would have been a good significant difference in their income. The problem with Lifo is that it creates what we call layers, meaning each year as you add to your inventory, that year creates a layer. And if rice prices are rising, which is our general assumption, each layer is a little more expensive than the layers previous. What GAAP is worried about is that we would have a Lifo liquidation. What that means is that as long as you're adding to your inventory, you're adding layers, but any year that you reduce your inventory, you're going to peel back layers. You're going to have a liquidation. And that could sometimes be accomplished on a temporary basis, meaning at the end of the year, you just don't order much of your inventory, and therefore your inventory drops at the end of the year. And then in January, the first of the next year, you start ordering again and bring it back up. That would be considered a temporary liquidation. GAAP says that when we have a temporary liquidation, we ignore it because that will distort our income, because what we're selling in those earlier layers is less expensive items from way back when we first started. And so what we don't want that to distort our income, make it look better. So if the liquidation is going to be temporary, now if liquidation is permanent, then we go ahead and do that, meaning we're going to, on a long-term basis, reduce our inventory to more efficient levels. That's one thing. But if we are going to buy that inventory and bring it back up to a more normal level, or even an increase, then we would treat it as if that liquidation didn't happen. So, retail method, there's an explanation that I've put in Desire to Learn. It's actually a simpler way. You track everything with a retail price because that's easily seen, and then you have to adjust for cost for your balance sheet. You can follow along with the example. However, usually this is combined with Lifo, and so the example that they use in the reading uses beginning inventory in calculating your cost to retail. If you truly use Lifo in connection with the retail method, you would not use the beginning inventory at cost and retail as in your calculations. You would start with the purchases and go from there instead of all of it. That gives you truly Lifo. So, inventory shrinkage, damage and theft is what we usually think of. Things that are stolen, things that get broken, that's easily accounted for. We reduce our inventory and debit the cost of goods sold, typically. Obsolete inventory, much more of a judgment call and needs some guidance. We have to identify, typically we do so by looking at reports that show us inventory that's not selling. You might call it slow-moving inventory. Then we must adjust or look at the possibility of adjusting to lower of cost or market. Now, the market value of our inventory is now defined under US GAAP as one choice, net realizable value, which is the estimated selling price minus selling costs. You do not have any other choices like there used to be. Just net realizable value. So you figure out net realizable value, you compare that to the cost you originally paid for it, and you apply the lower of those two. You can apply that to each individual items, you can apply it to groups, or you can apply it to the whole inventory at once. GAAP does not specify which one. Items is the most conservative, doing it the whole is going to seldom result in any adjustment. Most companies probably use the middle ground and do it by groups. Our homework and examples will do it by individual items just because the data we have supports that much more easily than the other two, but you'll get the idea. This applies to even stuff we have not received. For instance, if you have agreed to buy inventory at a particular price in the future, you haven't actually ordered it, actually got received delivery, but you have a firm commitment that says, I'm going to buy 10 of these each month for the next 2 years, and this is the cost. If that's the case, and the value or the price in the market, we're talking about things that are more like commodities, like this could be like wheat or some oil or something, you have made a commitment to buy that, and the price drops below what your commitment is, you actually have to record that loss because you're going to pay more than it is worth, because that's your commitment. That needs to be recorded even though you haven't received it yet. So when the price changes. All right, once you have figured out the net realizable value and compared it to the cost of the inventory, take the difference, that is your loss. We're going to debit cost of goods sold most of the time because this is part of our business model, and we credit either allowance or credit inventory depending on what's easiest for the record keeping. Once you have lowered that inventory down to its net realizable value, there is no reversal, meaning if the value goes back up, something changes again, there is no recovery of that loss in US GAAP. That kind of recovery is allowed under IFRS, by the way. All right, dollar value Lifo, there's an explanation that will help you with this and give you some examples. We want to treat the group or pool of items as one. This makes, rather than individual items of inventory, this reduces liquidations. So the big issue is, what do you include in a pool? How many pools do you have? You could use one pool for all your inventory and you'd have a lot fewer liquidation issues, and it would be relatively straightforward in your accounting. You're going to get challenged by auditors and by the IRS as to how you apply that. So most companies are going to have to choose multiple pools of items that are similar. So you might have a pool of inventory that is clothing if you're Walmart, and one that's sporting goods if you're Walmart, type of thing. So what you're going to do is adjust for inflation. Typically you're going to use an external measure of inflation, what prices are changing in the marketplace. You could use an internal based on your pricing, how much you have raised your prices, but typically you're going to have a better, you'll feel more like you've got the information that's verifiable if you use an external measure. And so what you do is adjust for inflation. You divide by the inflation rate, 1 plus the inflation rate, in order to strip out inflation. Then you compare your inventory without inflation to what the beginning inventory was. If your ending inventory after taking out inflation is higher than your beginning inventory without inflation, then you have a new layer. And that layer then is considered the layer for that year, and you multiply that layer by the inflation rate. Just that layer. So you have adjusted the underlying layers back to their original cost, and then you apply the inflation only, the new inflation rate, only the amount you added that year.